Well, hello everybody. Welcome to your session for this evening, and apologies once again for the need to reschedule. I hope you're all well wherever you are on the planet. I know we've got a few guys who are from the UK here today. Evening, Adrian. Let me know you can hear and see me okay. That'd be fantastic. Thanks, Wayne. Yeah, absolutely. No horse dramas today. Horse is going well. Thanks, Wayne. That's awesome. Right. Okay. Well, let's get things kicked off. We are going to look at some live markets, do a little bit of a news thing before we start, look at what's driving markets, etc. Just to bear in mind, of course, that the views expressed are mine and not representative of Go Markets. But for both me and Go Markets, it's important that you recognise that this is for educational purposes only, not direct advice to take trading action. You need to make your own choices about what's a fit and what's not a fit. And yes, they do, Michael. But obviously, Michael's asked, do the market updates get recorded? Yes, they do. But of course, they're quite redundant once they've been. I mean, they're okay for the next sort of couple or 3 hours or so, I guess. But really, so if you want one and you can't make it right there, right then of course email me and I'll pop you the link through. Thanks, John. No signal in mornings yet. No worries, Michael. Just ping me a message and I'll sort that out for you, buddy. Okay, so let's look at what's going on. Let's look at what's come across the news. It's been a very odd sort of 24 hours, really. We had US equities close lower, with the exception of the NASDAQ, which almost traded neutral, but they significantly pared their losses. So there's a big expectation that the US futures were getting slammed before market open. Sure enough, when the market did open, it got slammed on the way down, and then there was a big V-shaped bounce, really wide range. And US futures were steady all day until the European markets opened. And now we're seeing it sort of drift downwards. Asian markets were mixed today. The ASX was the outperformer. Nikkei did okay in terms of finishing in positive territory. European markets are mixed, but the major indices, the CAC, the DAX, and the FTSE were all up last time I looked, about half an hour or so ago. We'll have a quick check-in on those. Good morning, Ranjiv. Great to see you here. And US dollar index has bounced around a little bit. It retraced yesterday back up to overnight, in the overnight session, if you're in Asia Pacific side, back up to a key level at 19. Precious metals are pausing. We'll have a look at the charts of those in a minute. Cryptos are under incredible pressure, not only in bear market territory, but both Bitcoin and Ethereum down 40% plus. We've already had inflation jobs data out in Australia. We had the People's Bank of China keeping interest rates on hold, which nobody expected otherwise. And we had some mixed numbers out of Japan as well. Of course, we have got some significant data this evening. We've got weekly jobs data and the Philadelphia, or the Philly Fed Index, as it's called. That's manufacturing data. They're both out a little later on. Hi, Alison. Good to see you here. I know you've had difficulties getting here occasionally. So let's have a look at some meat around those bones. There's the futures. These are all sort of down about 0.2% prior to European market open. You can see not only have these dropped off, but also the Euro futures have dropped off as well. They were up in excess of 0.6% earlier on. Crude under pressure. Copper's starting to drop off again after looking a little more positive in the early part. We've got gold and silver both dropping. Gold really struggling to break 1870. We'll have a look at that in a moment and why that's important. And so you can see the strength is in, from an FX point of view, the strength is in the commodity-based currencies. A little bit in the yen, and the US dollar, as I said, is holding on. The US dollar index is holding on to 90. That's a key level. So really, these are changing have changed quite radically over the last couple of hours or so. Let's just have a look at some charts. So we'll look at the S&P 500 first. Good place to start. We appear to have some support in around about this 4050 level. We had a reject. That was the low last week when we were getting all the inflation concerns. shut down there on market open again, and then straight back up again. And you can see how it's drifted down. If we just put this on a 30-minute chart, you'll see. Actually, let's put on an hourly chart. So this was last night's action. This was market open. And then this is what happened. And then in Asia and in Asian trading, we were pretty neutral, and then we've dropped off over the last couple of hours. We'll see very similar in the Nasdaq. We've been trading in a range all day, and then we've just dropped down again over the last couple of hours. If we put it on a daily chart, you'll see again we've got a support in place. But if we look at close prices, it's almost looking triangular, shouting that the market's uncertain about what to happen next. Are we going to get battered by another inflation concern? Or now earnings are over? Are we just waiting for something else to happen? So it's really the market sort of struggling for anything to grab onto to indicate next direction. So we've got a really interesting place, not only on the equity markets, which are sort of in this uncertain period, but also if we look at the USD, really we've traded around here at this level for the last, so that's 5 sessions out of the last 2 weeks. But you can see how important that 90 is. We did trade below it. Good day, Rachel. Good to see you here. You can see that reversal candle yesterday, but again, softer today, which is interesting. So we've got a softer equity market and a softer USD. That is unusual. Okay, we'll look at the 30-minute chart. You can just see over the last couple of hours, it's not done anything whilst that, actually, that's a 30-minute chart. It's not done much over the last 2 hours since the European markets opened. And since the equity futures dropped off, which is surprising. So not much direction there either. This is all very relevant to what we're going to be talking about in a moment. If we look at if we look at gold, last 4 sessions we traded around 1870. You can see the close prices on this on the daily charts. Remember, the close is at 5 p.m. Eastern time in the US. You can see that really we've got no movement at all, despite the fact that the US dollar index has been bouncing around like a mad thing. Silver has pulled back a little, but trading within really quite a tight range of around about 60 cents, which is in percentage terms about 2% drop over the last couple of days. But we look as though we're fairly well supported around this 27.50 level. But silver certainly underperformed gold, which is interesting. But that may be a reflection of the obviously silver's more attractive to retail investors than perhaps gold is due to its pricing, and there may be some of that profit taking going on after really what's been a fairly good run up for the whole of the month of April. If we look at where it was at the beginning of April, then we actually pushed up to 12%. So possibly traders saw that this was a key level and decided, right, we'll just take a little bit of money off the table and bank some of this. We mentioned cryptos. There's cryptos now. They're having a nice bounce over the last few hours. You can see that key level marked on there at 21.50 on Ethereum. We're now up to 26.60. So we are getting a nice bounce temporarily, which is actually on the daily chart created this kind of. You can see that's a rejection of the down move. We had another go earlier in the day, but you can see where that is. So perhaps the market is seeing some value where cryptos have moved down to yesterday after, as I said, over 40% drop. Bitcoin's looking very similar. Interestingly, with Bitcoin, we've not only got this longer term support, which we tested, but we've got the 200 MA, which it managed to close over on the daily chart. And so we are seeing some positive territory again in Bitcoin compared to the close this morning, Asian time. Now let's get on to the currencies. Actually, let's just quickly look at copper. Copper's been had a major pullback, but again, you can see where it's come from. Even beginning or sort of mid-April, we're up nearly 20%. So to have what's that, about a 5% pullback, 6%, isn't unusual. You can see we're pretty neutral on the day. So again, looking to see if we can hold support at around about this 450 level. Now, 450 was important because 11 years ago, 10 years ago, 2011, that was its high. So it's not surprising to see it pull back to this level. So that's obviously impacted a little bit, not only on this as a trading instrument, but also the material stocks, the resource stocks were the underperformers in Australia today. So let's have a look at some currency pairs. Start with the Aussie US. And you can see that we're getting some buying coming into this on the 5-minute chart. Just put it on the daily chart for context. We are mid-range. Now, this is important. We've only got a range, really, of around about 100 pips from top to bottom, which we've been in since the middle of Feb. Been in since the middle of April. So over the last month, apart from a couple of trading sessions, this is what the daily chart has looked like. So if you wanted to daily trade FX, you're going to see this time and time again. If you look at the US yen, you can see again choppy R's in a tight trading range. Using the 50 EMA, it looks like the support at around about 108.50. So again, 100 pip difference or less than 2 ATR. If we put the ATR on this, you can see 71 pips. That's 1.5 ATR from top to bottom. Not much going on there. If we look at the Euro USD, and this is all relevant to what we're talking about later, look at the Euro USD. Again, we'll look at the daily chart. So the daily chart has actually been in uptrend, but we're stuck. We're stuck at this level of 121.85. So we have had some trend movement in this, or an attempt for trend movement, but we had a failed breakout just to bring us back to this. And so now we're sort of starting to look a bit triangular, a bit range bound again. Potentially, if we don't break this, we could quite easily see this trading within a tight range unless there's any inflation news, in which case we'll see a drop off again. If we look at some non-USD crosses, let's look at the Euro Australian dollar. We have had some trend in this. You can sort of see that was the key line we broke through, but it struggled to get through that for some time. And again, if we look at the actual up move on this, it's around about 100 pips and now we're stopped. So we have had some direction on this. The GB pound Aussie, we were actually looking at the GB pound Aussie, look at the GB pound US dollar first. We didn't look at that. You can see how that's range bound as well. Again, around about 50 pips from top to bottom of this range. There's the support around about 140. Actually, a little more. So we're at 141, 141.20 again. If we put an ATR, so the 121 pips difference, we'll put an ATR on this, so you can see. No, you can't. Yes, you can. There's the ATR, 89 pips. So it's again less than 1.5 ATR, which is really low. Hi, Chris. Good to see you here, buddy. If we look at the GB pound Aussie, we were looking at this morning. We thought there might be some action on this. So this is today's kind of, again, you sort of see, really, we're struggling to get out of after, again, we broke through a key level there, but since then, we pulled back, we went up, we pulled back again. So again, this range that we're in, look as though we could be heading into now. So around about 120 pips again, we'll drag the ATR on this. And we see that the ATR is 124. So again, really not much in terms of in terms of trend movement there, unless we break this, and then we could be away. So in terms of share CFDs, the outperformers, this is there was two charts that stood out today on the ASX. There was Qantas, which completed its bounce with a vengeance. It did very well, and the other outperformer was Afterpay. Drag Afterpay in. So again, we've got a clear bounce according to the bounce strategy we talked about before. Xero looked interesting. You can see there was some buying went on in this. That was on the basis of a breakthrough this level, which also corresponds to the 200 MA. So again, we've got a bounce strategy going on there. If we look at the Give you a couple of US ones to have a look at later. I'm at sort of lit my candle yesterday. Just watch this for 124.80, a break of that. Could suggest that again it bounces intact and up we go. And also, we just, where is it? The other one that I actually had a little intraday trade on was Microsoft. So with Microsoft, we've got a key level in place. It's probably a little early to trade this on a daily chart, but we've got a key level in place here and possibly even here. You can see how we've worked our way back up to that support. So we want to see it over sort of 245 to get interested in this. Qantas had bad news, but still went up. Probably means the bad news is priced in. But often bad news is good news if it isn't quite as bad as the market thought it might be. So I suspect that's what's happened. Just remember with any news that you see, the headline news that you see in the general media is based on how dreadful things are usually. And that doesn't suggest what's already baked in or what market expects, if that sort of makes sense. So there's a couple of things around the markets. Yes, absolutely. Okay, so with that done, maybe the horse saw the price of Bitcoin and jumped the fence. Absolutely. So let's go back. Okay, let's go back. And I know this is a common theme, but I make no apologies for this. Watch for Trading IQ coming along very soon. So we've got market action, we've got interpretation of that, application of developed systems, decision making and action, and then subsequently that creates the results. Now, there's two things that this topic on timeframes has is relevant to this. First of all, there's the interpretation of the market action, and then there's the decision-making action. So there's quite a lot of personal issues associated with looking at different timeframes to trade. So what we're going to do is we're going to look at those one after the other. So if we just give it some context about where this session fits into what we've been talking about over the last few months. Well, we previously covered the concept of matching strategy to market conditions. And generally speaking, when we think of strategy, we think of different vehicles. We think of different ways a market moves. We think of possibly altering position sizing at an intermediate level, according to an assessment of what the market conditions are. So a risky market, we may sort of reduce the position sizing. If it's a normal sort of market, we may sort of adopt our normal position sizing. And if it's a really strong market, we might increase that. So, but on top of that, and really the reason behind this session, it was interesting that one of the guys I talked to, maybe here, what did actually reference this time frame, and he's probably one of the more common questions I get from beginner traders. But really, when you talk to traders about timeframes, or when you see some information about time, it's all pretty unhelpful in terms of practical stuff. So they'll say, oh well, look, you've got a choice of being a shorter term trader where you scalp the market, or you've got an intermediate trader where you're trading sort of medium sort of time frames, or you've got a longer term slow burn sort of trader who looks for combining fundamental news with the technical picture. And that's usually as far as it goes. So Mike, I thought I'd take this to the next level and maybe see if we can add something to that general stuff. So some underlying principles. So first thing is, if timeframes have an influence on results, or may have an influence on results, then logically, and how long is that taking me? It should be recorded in your journaling process. So 19 minutes. So if that's a bit slow for me. So what I'm suggesting is that not only if you're really interested in looking at this, and it may not be the priority for you for right now, but it is. So if you're looking at this, maybe some of the things we talk about today, you should be recording in your journal. So obviously the time frame of the chart you've decided to enter, but why have you chosen that chart? Remember, journaling is about looking at your decision making. And combine that with something we've talked about before in terms of measure, maybe putting down some issues about market conditions is worthwhile doing in that process as well. The second key principle is, generally speaking, if we utilize the same time frame for exit as we did for entry. So if we enter on a daily chart, we should really be exiting on a daily chart. If we enter on a 30-minute chart, then on a 30-minute chart. If we enter on a 1-minute chart, we exit on a 1-minute chart. We never, ever, ever go up. So we never, ever sort of start with a 30-minute chart and then persuade ourselves to move to the hourly chart for exit because it looks slightly better on the hourly chart than it does on the 30-minute. So we can go down time frames, but never upwards. So if we're looking at if we're using a 30-minute chart for entry, we could go down to 15-minute chart for our exit decision making at some stage. Perhaps if the market shot up significantly, you've got a choice of tightening if you're using an EMA, for example, as a stop. Your choices are maybe you switch from a 20 EMA to a 10 EMA, or you can adjust the time frame. You can move down to a 15-minute chart. Likewise, if we're getting near profit targets and that sort of stuff, we can do that sort of thing. But we never go back up again. Once you've made the decision to look at a shorter time frame from exit, that is where you stay. Thirdly, we've previously referenced and had sessions on time management for traders. Time management systems are really something you should be starting to look at as intermediate traders. Not only a daily agenda, which gives you, should that be sort of logged in terms of time before you start to have a look at the market to give you that assessment of where market is, but may include what I would term a default diary, which is perhaps you've got a diary of 2 weeks or a spreadsheet of 2 weeks, and you say what you're going to do relating to your trading activity at various points within those 2 weeks. So you pre-plan your trading activity, and of course some of that's going to be direct trading, some of that's going to be your journaling stuff, some of that's going to be creating your plans and your development stuff. So, and I think we covered that when we did the personal. One of the intermediate trader clinics was on trader development, and I think we covered it then, and we give an example of that. It makes sense to do that, and then another thing to say, for the purposes of this session, I'm going to split timeframes into 3 broad categories. Long term, I'm going to call 4 hourly or daily as your primary time frame. Medium, 30 to 60 minutes, and short is less than 30 minutes. Now, the other last note is for many, usually when we talk timeframes, it's and implications of timeframes, it's usually the entry that we're talking about, because we do require additional effort on entry than exit. There's 2 reasons for this. First of all, we've got a number of criteria we've got to tick off before we can sort of say, yeah, that's an entry. And secondly, of course, is we've got to pre-plan our exit we've got to decide what the time frame is, and we've got to pre-plan our exit. So the activity around entry is significantly more. And if you pre-planned your exit, it should run itself after that. So there's some underlying principles. Now, let's get down to some nitty-gritty. There are 4 primary time frame factors. Okay, first of all is market conditions, which is a potential sentiment change on alternative timeframes. You saw before when I was having a look at the market that there were, on some of the daily charts, there's very little movement in terms of Aussie USD was a great example of that, where there was very little change on a day-to-day basis in the market. There was no trend at all in the market on a daily chart. The second factor, and we're going to go through each of these in detail and give you some practical things to have a look at. The second I've called time of day access, and this includes access to markets and the timing of global exchange activity. So obviously, one of the issues with FX is that it's a 24-hour trading environment, and hence There are different exchanges that are working at different times in the day. The three major ones are obviously the Asian, the European, and the US. But we'll talk about that and the implications of that. Then there's personal flexibility, which I've decided to call it that, which is the opportunity to touch base with markets, both from a practical point of view, in terms of what's possible with other stuff that's going on, and what you want to do, because ultimately you make choices not only in terms of whether you're going to trade or not, and what you're going to trade and how you're going to trade it, but also when you're going to trade it. So we may say, well, look, for right now, for where I am as a trader, until I can be convinced that this is going to really work for me, then I'm prepared to commit X hours per week to this particular activity while I'm learning, or while I'm developing, or while I'm getting confidence. And the final one is what I've termed time frame familiarity. And this is just having an awareness of what the potential challenges are associated with different time frame trading. So some of the challenges are different from long-term to short-term, for example. Those are the most obvious differences, and we'll talk about those briefly. So bottom line is that 3 of these are related to you. And remember that sort of how results occur. So this is that third. These all come under that third thing about decision making, and then market conditions is out of your control. But nevertheless, you've got to make a judgment on what's happening. You've got to do the interpretation on not only what the market conditions are like, but what is the time frame that we're interested in looking at trading. So we're going to look at these one after the other. Thanks, Leanne. So the first thing we're going to look at is what I've termed personal flexibility. So I'm tackling the market last, because that's probably the most complex or the most challenging. So we'll tackle the other 3, which are, that doesn't mean that they're less important. It just means they're probably easier to action for you for right now. So obviously for most traders, there's a limitation both in the times that they're able to look at the market, because they may be working, they've got family stuff going on, they've got other stuff that they like to do. And this, so this is both timing in terms of looking at the market and the frequency of doing so. So for some of you, it may be that you can only touch base with the market a couple of times a day for a few minutes. For others of you, you may have the opportunity to keep a close eye on it. And obviously, the MT45 app allows some increased flexibility for monitoring open positions. I would stay away, generally speaking, from entering, unless you've got pending orders. I would stay away generally from entering new positions using the app until you've got real confidence in your system. Might work on a shorter time frame when you're using limited criteria, but it's actually quite difficult to check those criteria easily. It's not very easy on the eye, apart from seeing price moves. Very easy to adjust things like trail stops, etc., which is when it really comes into its own. So it may be that you're able to look at a screen maybe a couple of times a day, and that will be your entry. That will be your entry criteria, and then use the app to monitor positions throughout the day. And of course, there's a degree of commitment, but also some prioritization, and that really sort of sits with where you are as a trader. Obviously, if you I've talked commitment a couple of times, but it's easier to commit more when you know it's going to work. Okay, so as a newer trader, when you're not so confident in your abilities to take on all this knowledge, all this new learning, put the systems in place, it's very hard to commit a lot of time to this, because at this stage it's really sort of in the realms of a hope rather than expectation. It's like a business. If you've got a business idea, you tend to sort of let it marinate for a little while and put some things in place, maybe just do a little bit of a pilot test, talk to some people, see if it's going to work or not work, and start to put some of the easy infrastructure in place. And then once you see it working, then you sort of ramp it up. You increase your level of commitment, increase your priority in terms of how you're spending your time, So this is trading is no different. So, and what is right for you is right for you. I'm not going to be critical if you say, well, look, I can only spend an hour a day doing this, or half an hour a day doing this, or 3 hours a day. It doesn't matter. There's no right or wrong with this, but you need to be real in terms of where you are right now. Logically, you would assume that low flexibility would lend itself to longer time frames. So if you're only able to touch base with the market for a few minutes a day, then logically you would say, well, look, because of that, then maybe daily charts or 4-hourly charts looking for the long-term moves are where it's at for me. But this also is dependent on the time of day, and this is a really critical point. So remember, of course, that if you look on an MT4 or MT5 platform at a daily candle, so if we look at GB pound, Aussie dollar daily, so this is what's happened today. But in terms of this candle maturity, it's not actually very mature at all. In fact, there's around 12 hours. We're only halfway through the trading day, really, on this candle. So it doesn't mature. If you've got in your trading plan, I'm going to use a breakout strategy. It's going to close in the top third of the candle, and it got to be increased volume, etc., etc. Then you've got an immature candle there. So you can't, according to your plan, make a decision on this. Unless, the only time you should be making a decision on this is the early part of the day. So, if we just take this back, you can see why I put that key level there. If you hadn't gone back, you wouldn't have seen that key level. You would have just seen, oh, well, look at that. It's a breakout trade. Yeah, hey, let's go. But the reality, and you would have gone for this morning. Actually, maybe not, because you wouldn't have been 60 pips above that, which is half an ATR. But you get what I mean. So if you're able to look at the market early in the Asian session, then you've got a full candle, which is the previous day's candle, all intact, on the volume there, so you can see. If you can't do that, if that's not the right time for you, then what you could do is look at the 4-hourly chart. Because, of course, the 4-hourly chart, there's 6 of them in a day. So you need to work out what time that is for you. But in terms of the market hours, then we are in third candle of the day. Okay. So this one here. So if we just look at the time, so that's 4. Okay, so that's 0 on the that's 4 o'clock. That's 8 o'clock. This is 12 o'clock platform time. So we're only an hour and a half into this candle. Okay. So you can use, if you can't trade the daily because you're not looking at it at the beginning of the day, then you could say, well, look, let's use the 4-hourly because I'm going to be able to see a mature candle. So you can alter your trading time, or the time you look at the market, according to when candles are going to mature if you're trading longer time frames. Yes, absolutely, Adrian. It absolutely, as a new trader, you've got to earn a living. You've got to be doing some work. You're not looking at the markets all day. And the reality is, why would you want to? There are dangers with looking at the markets too much, and I'll talk about those in a moment. And there's time, though I sort of have to look at the markets because it's part of what I do to rock up to webinars to teach you guys. There are times when I have to walk away. So I'll look at perhaps the markets after every, so I'll see obviously in Asian markets before I do my live update perhaps, but I'll do that anyway. Then I'll look at it sort of around European Open, and then I'll look at it again on US Open. But I can do that because I'm in Perth. If you're on the east coast of Australia, then that makes it very difficult in terms of time frame, in terms of timing. You have to go up very, very late to see the US Open. And then, of course, you've got work involved in that. So I completely appreciate it. And what you've got to do is, as I said before, there, just balance those out and really get quite sort of specific about what your personal flexibility is. Of course, there is an element of choice in this in terms of what you do with the rest of your world. But as I said, you've got to have some justification for increasing your flexibility in terms of when you can look at the market. So there's things to put in place first before you start messing around with your life, is what I'm saying. But certainly, there's merit in doing one of the things that I said before, in actual planning out when it is you're going to look at the market, because that's going to determine to some degree which timeframes are good for you. Second thing is the time of day. Now, although FX and index markets trade 24 hours a day, obviously share CFDs don't, we get these global FX exchanges open at various times during that 24-hour period. And during that 24-hour period, there are two periods where two exchanges are open. We'll have a look at that. And so what this means is there's at these open exchange times cross, this has an impact on liquidity, so the number of people trading, and also the spread. More people trading, the tighter the spread, generally speaking, and potential volatility. Some of that's created by the economic data, because the economic data tends to be released around about the time of the opening of the FX exchange, so just before. So, for example, a lot of the US data, the US jobs data tonight, will come out at 8:30 a.m. New York time. Market opens at 9:30. So we'll see that particularly in the US. And if you're wanting substantial moves on medium or short time frames, these times where the exchange is open are absolutely critical. Arguably, you could say the same thing for the 4-hour chart as well. With daily, again, you're basing that as much on fundamental or long-term trends. So the movements associated with exchange opens and when exchange times cross, which I'll show you a couple of things in a moment about that, are possibly less critical, but nevertheless, they're not unimportant. Okay, so here we go. This is based on GMT. So this is the Asian session, starts at 11 p.m. GMT, runs through, and you can see there's a slight cross between when the Asian session stops and the European session starts. And then we've got about 3 or 4 hours. Obviously, this varies depending on the time of the year and time zone changes. So you've got, this is the major trading period. Okay, if we look at this chart below, it shows you the hourly ranges for the majors. Okay, so every time we see a peak, it's a new market opening. So if we just have a quick look at a chart here, if we look at an hourly chart on GB pound US, okay, so this is the Asian Open. You can see a little spike in volume there. This is European market open. We've got another spike in volume there. All the time it's going to be the same. So we sort of come here, there's your spike. Change the pipe, change this to so there's a spike, and there's a spike, and there's a spike. Asia, Europe, US. Okay, Asia, Europe, US. All right. If we drag on another, just another one, just to sort of demonstrate this, we can probably put let's put an Aussie US on here. Same deal, spike, spike, and spike. Spike, spike, and spike. And what you also notice about the price movements, there's the big price movement associated with Asia market open. There's the price movement associated with European market open. There's some price movement associated with US. There's Asia, Europe, US. Asia, Europe. So you can see a lot of the price action goes on. A lot of the increased volatility goes on when those markets open. Now, of course, there's other things going on as well, particularly in the US overnight. We get the Fed doing their thing, releasing minutes, interest rate decisions, all sort of in the afternoon, usually in the afternoon US time. And most of the data's out pre-equity markets. Some of it comes within the hour afterwards. Some of that, I think the Philly Fed tonight is after market open. But but generally speaking, or theoretically, you would suggest that perhaps these times are when you may get the bigger market movements on. If we look at the daily chart, we're obviously not going to see that. If we look at the 4-hourly chart, we might see some of that. But again, these are going to be smoothed out. Because remember, shorter time frames, there's lots of different, doesn't matter shorter or longer. So there's lots of different market participants, each with their own agenda. So what does all this mean in terms of considerations for you? Well, first of all, low flexibility but medium time frame trading may merit looking at the hourly ranges and potential currency pairs. So that should be in potential currency pairs. So if you are trading currency pairs then, and I've only got a finite amount of time to enter trades, you haven't got that ability to keep on checking in on the market a few times a day, then you might say, well, look, I'm going to limit my activities to when the market's most likely to move. So it's going to be around this time here. It's going to be around this time here. Okay, so so where we are, we're 7 hours away. So around about 7 or 8 p.m. Perth time, about 9 p.m., 9 to 10 p.m. Eastern time. If you're in the UK, you've got actually not a bad deal here, because you've got both reasonably sociable hours. I'm not suggesting you move to the UK, but there is an advantage there, as I said before. So those who prefer lower volatility, and some people might, some people like that, maybe would like the lower volatility move. A lot of EA traders like the lower volatility to as well as the higher volatility. And so one of the things that a lot of EA traders do is they'll do their tests at different times in the day. So it might be that their model A will work really good in between those exchanges, when two exchanges aren't open. But it doesn't work so well when two exchanges are open, because the increased volatility, increased market volume. And that's one of the things you can test, of course, and one of the things you can start to have a look at. Now, as I said before, there's less impact on the long time frame and less impact on the shorter time frame. So if you're trading 5-minute or 1-minute charts, intense though that may be, the exchange open times really may not alter your approach. So it may matter less, but that doesn't say it doesn't matter. Okay. It may be advantageous to be trading when there's lots of volume kicking around, because you do get the moves that's significant. If for example, we look at, let's look at a 15-minute chart. So this is European Open. So you see we've got that initial movement. So that would have been a potential bounce trade off a resistance level. Okay, so we could have taken that trade there to go short. Really tight time frame. This is a 15 minutes, so we'd have a tight profit target probably around there, so it would have been triggered there, and then we could be in on this bounce. You can see now that this move has engulfed these last two candles here, so we could be in on this one and trading this one again with a short-term time frame. So despite the fact that on the daily chart we're going nowhere with Aussie US, if we look at the 15-minute chart, we've potentially got 15 pips here, 18 pips there. And although that might not sound a lot, it's all dependent on the volume you take in the trade. It all depends on the lot size. Because of course, with this, you're going to have a stop. If you were to trade this bounce down here, then you'd have a stop that was sort of 1.5 ATR below that. So we're only 7 pips. So it's only 10 pips away. Okay, so somewhere around there would be a stop. Okay, so you're still risking, but you're trading a higher volume. So your stops are tighter, your profit targets are tighter. But what that stop being tighter says, well, look, if I'm risking 1% of my account, then 1% is a lot more in terms of lot size than if I was trading a longer time frame. Okay, and I had it up here somewhere as a stop. Does that make sense? So, hang on a second. Low volatility has enabled my trading between a very predictable and reliable range on the 5-minute chart. That's really good to hear, G. And there's a lot of people in that place. London morning is weak on follow through with all the algos running. Algos run on every market, but certainly there's a lot of trading done in that first half an hour. And those of you who have heard Magnetic Trading Talk, a lot of their strategies are based on that market imbalance, which is created when markets open. So when they, particularly in the indices, of course. So and particularly around economic data times. And you've also got to understand that when people see these key levels, irrespective of what time frame it is, they position accordingly. So if they think it's going to bounce, it's moving up to a resistance. Let's just get these out of the way. Okay, so when it moved up to here, or when it was moving up to here, there was lots of sell limit orders kicking around there, and that helped move it down. Then, of course, people see that move, and of course, the automated traders have got sort of something set up for that, and so we get that selling volume increased. And of course, there we saw it there, the higher volume based on that move after it hit this key level. Still high when it hit this key level because it did this in a bar, of course. Just having a look through some great comments and here, guys. Keep them coming through. I hope that's interesting. So consider when you're planning your time out. Say, well, look, do I want a low impact sort of trade where it's chill, in which case I'm going to trade outside. I'm not going to trade in this period here very much. I'm going to avoid the start of the Asian session. I'm going to see how things pan out with that. Let me give an example. So one of the strategies I've used in the past is really, really simple. So if the NASDAQ moves, I was talking to somebody about this today, if the NASDAQ moves higher from Asian Open, then I'll potentially enter a short-term trade, maybe on a 5 or a 15-minute chart, okay? Unless there's a reason not to from a technical point of view or data point of view. And I'll stay in that trade and see what happens to the NASDAQ on European Open. If it continues to move up after European Open, then I'll stay in it. If it doesn't, I'll just cut it off wherever it is. So I'm actually using a strategy which is based on the exchange times and the fact that markets move around those times. So if we look at the NASDAQ today, for example, there we go, there's a NASDAQ daily. So if we look at the NASDAQ daily, as I said right at the beginning, bit of a choppy old range here going on, but it's actually quite significant in terms of its size. Okay, so that says 3.4% from top to bottom of this range. So we could trade the daily chart quite easily. But if we don't like the fact that it's in a range, remember the ATR is 282 points. Okay, and so the ATR is still, we'll talk about this in a moment, is 558 points. So where are we at? We're at 2 ATR, okay? So we could try and trade this, but you can see how there's not a lot of direction. It's stuck in a range. It's less than 2 ATR. But if we look at let's take the 5-minute chart. Okay, so this was Asian Open here. This didn't excite me at all. Okay. But theoretically, I could have taken a breakout trade at this point here on this with a stop at this place here. Now, if that had continued to drift higher, this I think is European Open. So this is around economic data. European Open starts to drop off. So even if I did take this, even if it hadn't held my stop, at this stage, it's down lower at European Open, the European Exchange Open, than it was when I got in. So I'm out of it. Poof. No messing. Whereas if we look at perhaps, let's just check the scroll off. Maybe a couple of days ago. So that's today. Let's look at the 15-minute chart. It's just a bit noisy. Okay, so here's a good example. Okay, so we take a trade here. European market open is here. So at this stage, we're in here with a stop at this level. Make it that color. Okay, and there's European Open. It's good. So what I do is I trail the stop right up to there and trade it up and ultimately just decide when I've had enough and get out. Okay, so I just keep on trailing a stop, use a 10 EMA on that and then be out at this point here. So that's a strategy purely based on the market movement after exchange open. Does that make sense, guys? Right. Now, time frame familiarity. This is the third of four. Generally speaking, most share CFD traders or share traders or options traders trade daily charts, and other instruments are more commonly traded intraday. I would suggest that's not a bad place to be. Okay, I know some FX traders prefer the longer time frames. That's okay if that's your thing, but certainly don't start trading intraday on share CFDs. It's that much harder because your market's only open for 6 hours in Australia. Obviously a little longer than that in the US. It's 9:30 till 4. What's that? That's 7.5 hours. So it's a very short time period in the day, whereas the indices will just keep on chugging along. FX will keep on chugging along outside of those. So that's the first thing. So one of the difficulties that some people have, and I know there's somebody, or at least a couple of people on here who have had this difficulty, is they're used to trading FX or indices, and they like the idea of that. But then they get attracted to share CFDs, which is a great place to be. Look, I do very well out of share CFDs. So it served me well going forward. Sorry, looking at the past, and so something I'm going to continue going forward. Other people see that and think, I wouldn't mind giving share CFDs a crack. But because they're not familiar with trading daily charts, they start to look at intraday charts and make decisions on those and often get hurt. Because, of course, if we look at what happens in share markets, then most of the action is at the start of the day and the end of the day. And although what happens in between is not irrelevant, it's really the volatility is often lower. There needs to be something else happens in the day to drive it. Now, in the US, that often happens. As I said, a lot of the Fed stuff is early afternoon in the US. So, but if you look at what happens in Asia, there's a couple of market patterns that you'll see time and time again, and this is where people get caught. So we'll often see that or that inside a trading day. So if we look at the ASX today, for example, let's just see if we can find the ASX. This was the source of that, by the way. Oh, sorry, I should have said that. So I got these charts from Investopedia, which is actually a great site. When I search for ranges in timeframes. So if we look at the ASX today, it was just one straight line up. So that's the other sort of market with share CFD. So it would have been all right. A little bit of a dip at the end. So it would have been all right just doing that. Let's just check on the US. Check on the so European markets are all positive. You can see the DAX and the CAC 40 are outperforming. The FTSE is a bit shy. Let's see what the futures are doing. They're still looking pretty samey. We'll have a quick check in while we're there. So that's the first thing to say is be aware of what timeframes work for your particular instrument. There are different practical and psychological challenges with trading different time frames. So from a practical point of view, the lower the time frame, usually the tighter the stop and the profit target, as I showed you on that chart, compared to entry price. And vice versa, of course. The longer the time frame, usually the further away the stop is. And this is why the ATR is really useful for doing this sort of stuff, because it takes all that stuff into account as well as the pricing of the underlying instrument. You don't have to work it out. It's not done on 20 pips on every time frame or anything like that. It doesn't really make a lot of sense. But the thing is, we're not used to doing that. So remember, I said, well, look, on this 50-minute chart, there was 18 pips there. That would be very reasonable for a 50-minute chart. But if you're used to trading a 4-hourly chart looking for a 100-pip move, then that's going to be a little bit of adjustment. You're going to look at that and think, nah, that's not worth it. But remember, of course, you're entering a bigger position because your stop's closer. Okay, so, but that takes some getting used to. That's the familiarity you need. And of course, vice versa. If you're used to trading, for a 20-pip move, and then you might start to cut your profit short a little bit on your longer time frames. So if you're used to trading a 15-minute chart and you move to an hourly chart, then again, familiarity works. So treat a new time frame that you're not trading regularly as a new strategy. And so what you would do is you would try it, check it out on the demo, get used to the pricing and the movement, and of course trading for less pip gain, but looking for larger position sizing. And then of course move it on to the trading platform or live trading platform, make it the lowest possible lot size until you get used to it, and then you can trade up. So that takes you, from a practical point of view, that does take a little bit of getting used to. So just be gentle on yourself and don't try and do it in 5 minutes. Then there's two other dangers that kick around. First of all, on longer term price charts, the danger is using short-term charts to tinker due to impatience or anxiety. If you're used to trading that higher intensity trading and you start to trade hourly charts or 4-hourly charts, then and you're used to trading minute or 5 minute, it's actually really difficult to leave it alone. Okay, leave it alone so it fits your plan. And this is a similar sort of thing that we often see with share CFD traders. Is they'll do all the right things, they'll enter on the daily chart, they'll be all looking good, and then they'll just have a look at the hourly chart and, oh, that's just starting to pull back a little bit. I've got a little bit of profit there, let's just rip it off, only to find out that an hour later it's back up again. So if you're a tinkerer, then it may be long-term trading isn't for you. If you want to move to long-term trading and you have the ability and you see yourself tinkering a little bit, and you can easily tell that through your journaling process, then you can start to do something about it. You can own it and do something about it. Now, with short-term time frame charts, there's what I would call a sucked into price risk. So you become obsessed because you're looking at the screen all the time with a 1 minute, 5 minute chart. You become obsessed with price, that profit loss column, rather than what's happening to the chart. So you get sucked away from the price action on the chart and into profit loss. You can remove the profit loss column from your thing at the bottom. So if you find yourself doing that, maybe that's something to try. It's a bit radical. It may make you feel a little unsafe when you first do it, but it's an interesting one. But just be aware of that. The greater the intensity, the greater intensity associated with very short time frame trading does funny things to the head. Okay, and also with that shorter term trading, you've got to give yourself breaks. It's like anything. You've got a concentration level of probably a max of 40 minutes before you start to drift off, unless you're listening to somebody incredibly interesting or somebody who keeps on changing, keeps on adding different things into the mix. Okay, so maybe I should do webinars for 40 minutes. But it's the same with trading. You're at your best in terms of concentration and decision making for a finite amount of time, which will differ person to person. Now, the problem with trading is it is the same thing you're looking at. So there's no variation at all. You're just looking at prices going up and down, up and down, up and down. And so your concentration level or working at that optimum trading state, which again is something we've talked about before, but I may revisit later on, is something that you have for a finite amount of time. So you need to work out what that is for you, and then sort of do something about it. Now, market conditions. I know this is going on longer, but I wanted to do this properly. So this is looking at potential sentiment on alternative timeframes, and it's probably, as I said at the start, most difficult to address. But is and of course, irrespective of what time frame that you're trading, be it 5 minutes or 4 hourly, you should still be looking at a daily time frame to see where those key established price levels are. That's always important. But there's no doubt that if you look at different time frames, then sentiment looks very different. And this is okay, and it's merely a reflection of different trader objectives and time frame choices, and arguably automated trading, as we've already made reference to. And the bottom line question we've got to try and answer is which time frame may give me a higher probability opportunity for profit. So what I've done, and anybody who wants this as a slide or wants these slides can just drop me an email, is what I've said is that whatever time frame you're looking at, there are 3 market states. There's what I've called being in trend, which is a clear and established direction. So there's evidence of a trend reversal, a breakout, or a bounce. Absolutely, when no two traders are alike, and that's why you've got to find the right groove for you as an individual. There's what I call choppy markets, which are really range bound, little consecutive candles, so 2 or less before it changes direction again. Moving average is usually quite flat and less than 3 ATR. You could say that I'm not convinced about 3 ATR, but I had to plant the flag somewhere. I'm actually thinking 2 ATR is probably a better thing. And then volatility, where you've got a wide range in excess of 3 ATR or 2 ATR, maybe more than 2 candles consecutively. So if we look at the Aussie US, okay, so we're trading in a tight range, but we're chopping up and down. There's not many times within that period that there was more than 2 candles in the same direction. Okay, we had 1 there where we tested resistance, and that is about it. So this is what I would determine a choppy market on the daily chart. Leave it alone. Okay, don't try and trade the bounces on this. And apart from that, it's less than 2 ATR anyway. But does that mean there's not opportunities on smaller time frames? Well, if we look at the 15-minute chart, well, there's obvious opportunities within that overall range on the daily chart. So if you see choppy on the daily chart, then you go smaller time frame. Maybe 30-minute chart will still give you some nice trends to take advantage of. Okay, if we look at Bitcoin, for example, that's an undoubted trend. It doesn't matter whether you look at the daily chart or the hourly chart, there's trends to be had. But it may be that you start to see this on the hourly chart and think, well, look, maybe the daily charts, it's actually quite choppy on the shorter term time frame, but there's definite trend movement on the longer time frame. Therefore, I'll trade this as my primary time frame, or maybe the 4 hour is probably better. Okay, so now volatility is when you get these wide swings. So now we potentially are trading within a range on Bitcoin. So between there and there, is that worth it? Well, absolutely. So let's just let's just put an ATR on here. So the ATR is 3,400. So we've got 78,000. Is that right? Not 78,000. 7,800 on this. So it's well over 2 ATR. So that suggests that that's probably okay to trade on the 4 hourly chart to take advantage if there's a bounce there. So that would be what I would call a volatile market. And you can often see this, you can often see whether it's turning into a volatile market. Let me just get rid of this. And let's put another ATR on this and make it a 6. Okay, there we go. Should have made that a different color, sorry. That's a ridiculously poor choice of color, Mike. Let's use that. So this is a 6, this is a 14. So you can see that the 14 is above the 6. At this stage, we'll be thinking, right, okay, we're going to, this volatility is increasing. So the shorter term ATR is moving faster than the longer term ATR. Now it's the opposite is the case, and you can see that reflected in those candles. So once we've determined these 3 types, if it's state 1, i.e. the trend, any time frame is suitable. If it's state 2, where it's choppy, invariably you've got to look to the lower time frame. Or if it's choppy in the lower time frame, you look to the longer time frame. If it's choppy on both, you go away, you take your toys, and you come back the next day. If it's state 3, then longer time frame is possible, but you may use a shorter term view, so you may choose a tighter time frame for exit. But lower time frames will generally offer more opportunities for a move that you can take advantage of. As I said before, if it's less than a 30 minutes time frame, if that's what you prefer, then longer time frames are less relevant. So I wouldn't worry about whether it's choppy or not on the longer term time frames or in trend or volatile. Outside the established, that should be okay. Outside the established key levels. And of course, this excludes longer term trading ideas from a fundamental approach. So some of the things we can look at, the angle of the moving average is a good guide. So if we look at daily on the Aussie US, sorry, if we look on, what have I done with this? There we go, that's back to our norm. So if we look at the angles on the MAs, so they're both pointing fairly significantly upwards, just starting to flatten off a little bit on that pullback. But if we look at the daily chart, you can see those moving averages are going nowhere. They're flatlining. So essentially, there's another clue as to what could be a choppy market. Momentum's another thing, so that's the distance between the two MAs. If we can see that either visibly or we can use the MACD, and we can see how small these histogram bars are compared to the norm. There's the norm, there's now. So that says choppy market, low momentum in low histogram bars in the MACD, so very little difference between the two MAs. I've mentioned the short versus long-term ATR. And of course, all those may be worth exploration as you investigate this further for yourself. So your actions in this session, I hope it's been useful, but there were 3 considerations there with the personal component. So your flexibility, your timing of the market were the 2 that we sort of talked quite substantially about. And then of course, there's the latter one, which is going to require a bit more work on your part, which is putting some work on the market conditions through time frame. As I said, if you want a copy of the slides, happy to flick them through so you've got something to have a look back at. The video recording, again, I can make available, but it gives you something to start working with. It is a tricky one, but I hope that gives you something more solid and more useful to work on when you're looking at time frames, and perhaps you've heard just in the glib couple of things. Well, short term means this, long term means this. A lot of trading happens before opening and after close. On share Safeties, that's an auction, and so that's how your final or your opening price is created and your closing price is created. You tend to get a little bit of repositioning with some brokers, particularly not Go Markets, but there are other brokers out there that tend to reposition a lot, maybe even close the market for 6 minutes. I know a couple of brokers that do that, which is really not good practice. Yeah, good win. That's great. Thanks, Adrian. You're very welcome. Always great to have you along. Cheers, Michael. Thanks, Alison. Cheers, Ross. Gives you some things to work out there, mate. Thanks, Peter. That's the aim. Give you some stuff to do. Blue teachers, eh? Alyssa, you're welcome. Okay, guys. Well, look, thank you so much. Have a great weekend, you too. Thanks, David. Cheers, Chris. Thanks, Rachel. Cheers, Ranjiv. Good to have you here. See Tony, Robert, John, etc. Thank you so much if I've missed you. Apologies for that. But you're very, very welcome. And thanks for all kind feedback. You guys take care. We'll see you again soon. Bye-bye for now.